Hi, and welcome to Business Advisory and Tax Tips. I'm Michelle Burke, coming to you live from Annapolis, Maryland. Many of you know, after 30 years as a CPA and tax accountant, I went out on my own last January and formed Health and Taxes. Every Wednesday at 5 p.m. Eastern, I come to you live to bring you a business tip or a tax tip, something educational. And today we're going to be talking about cost segregation studies. And we have a great guest for you today, Joel Grushkin. Welcome, Joel.
Thank you, Michelle. Great to be with you.
Nice to have you here. But first, I want to tell you a little bit about my partnership with Veracity Advisors. I have Michael Sims here, who's I'm formerly a business partner. I'm working with him to bring you great guests like Joel to the table. And with that, Michael Sims is a partner with Veracity Advisors. He's a high-impact business tax wealth coach, disrupting the CPA referral model while delivering uncommon results for clients. And with that, I'll let Mike give you a little more details about how that works.
Hey, Michelle, thanks so much for having us, and really glad to be back and look forward to future appearances. We at Veracity, about 4 years ago, recognized that there was a broken link between the advisor world and the CPA and accounting world. And that broken link, which was being facilitated by referrals, really put CPAs at risk of losing those clients, and certainly did not comport well for the clients at the end. And we found coaching through a group out on the West Coast, elite resource team, in developing what we call the team-based model. And we're able to now partner, and we only partner with CPAs, providing service and support to develop client fact patterns in such detail that we can work with the CPA and deliver proactive, holistic, and comprehensive plans. So for those CPAs who want to represent themselves as perhaps a family office to high net worth clients, we have those resources and relationships to bring to bear. Likewise, for those who want to engage with small business owners and really provide value beyond just doing their taxes, we have a network of resources such as Joel, that when we identify opportunities for proactive planning, engage with the specialist, bring them in, do assessments, and provide a lot of times at no upfront cost a review and assessment for the business owner to see the value from the CPA's perspective, really entrenching the CPA as the most trusted advisor of the client, and really like to say we just do fulfillment. Our job is supporting you, engaging with the professional and the business owner, and really facilitating the plans and the programs and the specialty solutions for the client. So it's a lot of fun. We don't sell anything. I like to say we don't sell anything. We solve problems, and we represent clients to various industries to find the best solution. So it's a lot of fun.
Yeah, I know as a CPA, it was really great to be able to partner with you, to be able to bring these tax specialists to the team and these specialty solutions to the team. So thanks for coming back on today and introducing me to...
Most people don't realize there's only 72,000 pages in the U.S. tax code, and CPAs operate in sections of it. But really, to have a team that can collaboratively identify opportunities and use all of the tax code for clients is the sign of a CPA who sees the future.
That's a really good point, Michael. I know that I've always been kind of a generalist, and I've worked with specialists on different areas, and Cost Seg is one of those. And yeah, it is great to be able to tap into that resource who can focus on that section of the tax code, the tax regulations, all the guidance. It doesn't just stop there with the tax code. So yeah, it absolutely helps us to bring a whole breadth to our practice that we wouldn't otherwise be able to do as a solo practitioner.
Well,
So with that,
on that,
yeah, go ahead.
and on that, to help introduce Joel, one of the reasons why we embrace cost segregation initiatives, and Joel specifically, is that most CPAs, when they work with business owners or individuals who have commercial property, the easy route is just to straight line depreciate the value of the asset over a 39-year period. And it's engineering firms aligned with CPAs who can break apart the components of the building and create accelerated depreciation. There are many different firms that do it. We feel strongly that Cost Segregation Initiative really leads the way in the standard and the quality of the service. And that's really the most important reason to engage someone like Joel is if anyone ever has any questions, we know Joel's going to be there with Cost Seg initiatives to stand behind their work and not be left out in the wind blowing by ourselves.
Thank you, Michael. That's a great lead in to my introduction to Joel, and you're exactly right. It's when you're talking about these high dollars and the benefits to the taxpayer, it makes sense to make sure you invest in a trusted provider for that. So with that, let me welcome Joel Greshkin with Cost Segregation Initiatives. Joel brings 40 plus years of executive presence experience to CSI organization. His background includes 11 years with Arthur Young and Company. Yes, that's what's now Ernst & Young, as a principal and director of the firm's management services practice. He was also a member of Arthur Young's National Real Estate Industry Specialty Practice Group. His cost segregation experience has encompassed studies for developers and owners of commercial real estate, including but not limited to office buildings, shopping centers, manufacturing and distribution centers, specialty medical facilities, automotive dealerships, hotels, restaurants, financial institutions, multifamily residential, and senior living. You pretty much had the whole gamut there. Joel was previously a founding shareholder and chairman of the private equity venture capital practice group of DHR International, the nation's 5th largest retained executive search firm. He was also chief operating officer of a national consulting firm specializing in the startup and ongoing consultation of financial institutions, real estate developers in the areas of economic feasibility, capital formation, governance, M&A, business and regulatory affairs. Joel held positions as CEO, COO, and CFO at either the holding company or operating company levels in conglomerates with holdings in real estate development, home building, financial services, mortgage banking, retail and entertainment, and automotive. So that's quite a mouthful. But with that, Joel, thank you so much for being here and welcome.
Thanks, Michelle. All that really means is that I'm very old.
Well, I just go with when we're talking about Arthur Young, and we have to explain that that's then became the Ernst & Young over time, and it's now E&Y that you're dating yourself. But we'll let that go. We'll let that go. So, Joel, we're here to talk about cost seg and tell the audience what is cost segregation and what is a cost segregation study?
Well, basically, when someone buys a piece of real estate, let's talk about anything other than your personal residence. So an office building, a shopping center, a building to house your own business in. Typically, a commercial property that is non-residential has a 39-year life, according to the tax code. If it's residential, either single family or multifamily, it's 27 and a half years. So the easy way, as Mike was mentioning, for a CPA is to just say, it's a commercial building, it's got a 39-year life. So we back out the value of the underlying land. So it's basically the raw lot. That backs out because land itself doesn't depreciate. And so once you back the land out, you take what's left and divide that by 39, and you'd get equal parts of that you can depreciate on your tax return until you use it up or you sell And if it's residential property, like a apartment project, it would be 27 and a half years. And you go through the same process. The problem with that is that there are a lot of things in a building that appear to be construction that can be depreciated over a shorter life. There's going to be 5-year property, there may be 7-year property. Then when we go outside the building, we said the land doesn't depreciate, but the walkways, driveways, drainage systems, all the grading is all considered 15-year property. So the key is you really have the ability to change the way you depreciate it, which means you're going to take more depreciation in the early years of ownership, which is usually when you really need the cash flow. And so if you basically follow the guidelines and break the building apart, which we do by taking a set of plans and doing a complete takeoff off of the building. So we end up with values for every element of the building as of the date you acquired it or the date you built it. And you can accelerate that depreciation and improve your cash flow by minimizing your taxes.
Yeah, so a couple things you stated there. One is when people are buying a piece of real estate, they have one purchase price, and it's just without knowing any better, they just take that purchase price and throw it on their depreciation schedule. Maybe they know to take the land out, that it's not depreciable, but they don't have any details for all the components. And so that's where you guys come in. You analyze, what should the components be? How should that be broken out? What lives those have? And then that's what gives rise to the benefit, the cash flow benefit, because you're taking deductions earlier. So tell us a little bit more about the benefits to a taxpayer. So we're kind of looking at cash flow, right?
It really is all about cash flow. And it's about whether or not it makes more sense to take that, improve that cash flow up front and have use of that cash rather than trying to stretch it out over 39 years. With the idea being that you probably won't hold the property for 39 years. The number of people that actually have a property to the point where they've used up all the depreciation, a very small number of people. And so when we either will do a study when someone first acquires a building and do it right away. And let's say if it was in 2020, because of the changes in the tax law that came about because of the CARES Act and then the Jobs Act prior to that, we have the ability to take bonus depreciation on certain elements of that purchase. And so, as I said before, we have to back the land out. And once the land is out, we have what would be your depreciable basis. So if somebody bought a building for $10 million and it was determined that the land was worth $3 million, take out that $3 million, your depreciable basis would be $7 million. And then if you make improvements to it, you add those improvements in, then that whole thing would typically be divided by 39, or if it was residential, by 27.5. But we go further. We take a set of building plans and we do just the opposite of what you would do if you were building a building from scratch. When you're building from scratch, you sit down with an architect, you talk through what you want that building to look like, what kind of features you want it to have, and then the architect develops a set of plans that he has to go out and get bids from all the various specialties. So the plumber, the electrician, the framer, the HVAC company, and they bid out all of the various parts of that building. Well, we start with in most cases, a completed building, and it might be 2 years old, it might be 100 years old. And we have to take a set of plans, back the land out as what its value is the day you buy it. And then we take the set of plans and we do a takeoff. So we are starting with a completed building and breaking it down into the systems, the plumbing system, the electrical system, and so on, put values on the systems, then break the systems down into subsystems and component parts, and put values on everything. So when we're done with a study, we know what the value of every square foot of drywall is. We know the value of every individual piece of pipe, every outlet. And I mean, it's really down into minutia. But by doing that, we can look at what the real lifetimes are of every one of those elements. And typically they get categorized into lives of 5 years, 7 years, 15 years. And that allows you to be able to do that. Now, on a purchase now, because we're into this period where we have what's called 100% bonus, we break down a building that you've just acquired. And again, it could be a 100-year-old building. And we have to factor in the values of all those elements, break it down into 5-year, 7-year, 15-year. Everything that falls into 5, 7, or 15 years is eligible for the bonus, which means you will 100% of those values and fully depreciate them day one. And it is a big number up front.
Yeah,
and I think
go ahead,
what's
Michael.
important there, Michelle, is, and I've seen this in talking to several CPAs, and why it's the technicality is important is, a cost segregation study is something common in this space, but certainly if a client were to undergo audit, it would be something that they look at, because you're taking a depreciation on certain segments of a property. And having spoken with CPAs who proudly proclaim they do the study themselves, they figure out what's flooring and walling and plumbing, and they assign a value to it and depreciate it. That's a red flag. And that really lights up for the auditors and really puts the CPA and the client at risk, where I have the utmost of confidence in Joel's entity. Is there's a industry organization where 34 people in the United States are certified cost segregation specialists, and Joel's organization employs 2 of them, and there are many. I'm here in South Florida. There are a couple of large firms that really promote cost seg and really go out of their way to try to garner business, and they have no one who's certified.
That's right.
So that's an important facet to look at, especially when you look at what the potential consequences could be.
Yeah. So thanks, Michael, for bringing that up. And Joel, I'll let you speak to that as well. I've been on both sides of the transaction. I've been in Pricewaterhouse's national office where cost segs were being done, and we were being very careful, because you don't want to do something that comes up for audit. I've also been on the client side, working at the client where studies have been done for me. And I want to make sure that I have a reliable firm doing it, because I don't want to be there someday trying to defend what the work they did for me, 3, 4, 5 years down the road. So yeah, and it was something, this certification is something I wasn't aware of. So Joel, tell us a little bit more about this certification.
Yeah, about 17 years ago, a group was formed called the American Society of Cost Segregation Professionals. And it's the only body that actually goes through a testing process for its membership, and not only makes the individual go through the tests, but also they have to submit finished work product, so that the society can review it and make sure that their actual work product is hitting at least at the standard levels. And the requirements even go beyond what the IRS requires. And in fact, to the point that the IRS has really followed the progress of the society, and the IRS has been updating their audit guidelines for cost seg based on the qualifications the society's requiring. So it's even more stringent than what the IRS says. The issue, as Michael was saying, unless if a CPA claims they're doing cost seg themselves, unless they can actually break down blueprints and determine how that building was constructed. Because, it's like looking at a plumbing system. The value of the plumbing system, and in fact, if you remember back in 2014, when they started really making a big deal about all the maintenance and repair regulations,
Right.
and they changed the code. Part of that was to bring focus to looking at what the system values were, so that when you had to repair something that was part of a system, you could look at what portion of that are you repairing. And do you have to capitalize it, or can you just take it as a maintenance and repair item and expense it? So that's at the point where people were saying, somebody's got to figure out what these system values are. And if you can't break that building down off of a set of plans to be able to determine how many pipe fittings there are and the lengths of the pipe and the different sizes, and that's the same thing. The structural beams for holding up the roof and all that, it's all different. They've all got different values. So the process of going through this, and this is where the society comes in, it is a very detailed approach. And it's not just looking at the receipts from somebody building a building, but it's looking at how those various things were used in the building. How are they installed in a building? And that sometimes determines whether they are considered 39-year property, or they could be considered 5 or 7-year property. So it is a very detailed and involved process. And we're fortunate that two of my partners are certified. One of them, who also is a CPA, but sold his CPA practice 16 years ago, is the chairman of the Technical Standards Committee of the Society.
Wow.
So we're fortunate that we have him, because he's the one that really stays on top of everything from a technical standpoint, and is also involved with the IRS as one of the reviewers when they're looking at changing something in the code that's related to real estate. So
And you can tell these are strategies. This is a wonderful strategy to check and deploy for things like, when you think about a doctor's office, they have to have special wiring and plumbing, and dentist's office, they have x-rays and lead walls, and people don't recognize when they walk in, they just see, 4 walls and a chair. But being able to break that all down and appropriately, and when we're not saying, inappropriate, appropriately depreciate those, provides a huge deduction for those business owners, especially in their initial years, that they've put it in to offset the expenses that they've gone to. And a lot of times, if they're tearing something out to put something new in, they can accelerate the depreciation on what's left, on what they're tearing out, and then accelerate the depreciation on what they're putting in. So it really benefits the client.
And that's one of the benefits that people forget about. A lot of people just look at a cost seg study as getting a big bump in depreciation expense right away, whereas over the life of ownership, once a study's done, if the study's done correctly and it really breaks everything down into systems, subsystems, component parts, and not just the short life stuff, but the stuff that's going to remain at 39 years. Like a plumbing system is 39 years. You're not going to change that unless you've got some portions that are used in a medical office building or in a dental practice where you've got to have hand washing stations. Then it becomes specialty. But the rest of the plumbing system is 39-year life. But if you have to replace it, let's say 5 years after you've done a study, and you're tearing out a whole plumbing system, you've only depreciated 5 years of the 39. So you have the ability to write off the balance before you put in the new. But if you haven't had a study done, how do you get to that number of what the remaining part is worth? You don't have the value for the system for the components. So that's where cost seg study becomes kind of a living document, and you use it as you go through.
Yeah, I think that's a great example. One of the things you mentioned there was the like tenant improvements and the receipts. Even receipts, if you just pay someone to build out your tenant improvements, they may just be, I had a 20% payment, a 20% payment, a 20% payment. It doesn't tell you anything. So I think that's a really good point, that someone like me wouldn't even know where to begin without understanding that. So Joel, we have an example here that you provided, like for a medical office. Maybe you could talk about it a little bit, just to help our listeners really understand what a benefit could really look like to them.
Yeah, this is actually when we do a study, we do a preliminary analysis first before we take on the client project, because we want to be able to show the client what we believe the benefits are going to look like. And it helps us determine what the cost is going to be, as we go through the process of looking at the specifics on a building, we can determine how much time it's going to take, which is really how we get to cost. This particular case was an old medical building, or an old building that a client of ours acquired, and they were converting it to medical offices. And the building itself was about $1 million purchase. I think it was 11,000 square feet. But it was in really, really rough shape. So they decided that they were going to have to really take it down to the studs. So all that was left from the purchase, we backed the land out. The remainder, after everything was stripped out, was just 39-year property. So when we did this, what we really looked at was the budget on what they were spending to do the build out. And in this particular building, it was $1,498,000, and we go through the process of, again, tearing the plans apart because they had just completed it, and we broke out the specialty items that are medical in nature. So, and this doesn't have to be a medical building; it could be any building where there are things that are required so that the business can function. Let's say you have a manufacturing facility and you've got to bring in different kinds of equipment. And typically the standard electric in the building isn't adequate. So you've got to run more lines. Maybe you need some special kind of air induction system, which wouldn't be standard. All those things that are considered to be a requirement for the business to function are considered specialty items. And whether they would normally be 39-year life, if it was standard or not, they go to 5 years. So you can accelerate that. So what we ended up with here is, because this was, I think, a 2019 project, acquired in 2019 and completed, we were able to find 1,039,000 of items that qualified into 5 or 7 year life in this case, and they get to take 100% of that depreciation in the first year. And in the case of the owners, this is a medical group that owned it, very successful California taxpayers, high tax rate, basically equated to $520,000 of net tax benefits immediately the first year.
Yeah. And, today in the world of COVID, when businesses are struggling, especially, medical offices and maybe restaurants, this is a great way to get cash flow into your business if you purchased something in the last handful of years but didn't go do a cost seg study. So a great way to really look at improving your cash flows to help you through.
Yeah, and one of the things that we didn't mention is that I think I started to say that, we do a lot of these studies right when somebody purchases, or we may come back in 5, 6, 7, 10 years later and do a study doing what's called a lookback study, which is actually approved by the IRS, and we go back to the date of acquisition. We recompute the depreciation using our methodologies to, again, break down everything into 5, 7, 15, 39 years. We look at how much they could have taken had they done the study when they first bought the building. So between then and now, and then we back out what they actually used. They get to take the difference all at once on the current year's tax return without amending any prior year's returns. So it's a really easy way to improve cash flow. And
that's a huge benefit. So I really encourage our listeners to think about what have you placed in service in the last handful of years, or even go back, like Joel said, and take advantage of it now to improve your cash flows when in this economic hardship time is a really good time to get that extra cash flow into your business. So Joel, go ahead.
I was going to say, because of the CARES Act, it used to be that when we did a look-back study, we could take what we found for the current year, and we did a look back, and let's say there was $500,000 of benefit, and the client didn't need it all in the current year. We were able to go back 2 years, and then you could amend those 2 years returns if those were years where they paid a lot of tax and get the money back. But with the CARES Act, they've actually changed that to allow you to go back 5 years. And so when the CARES Act first came into play, we were looking at, we did a project for an owner of some restaurants, and we looked at about 10 different restaurants that they had built, and we narrowed it down to 6 or 7. And we ended up coming up pretty close to about $800,000 worth of tax benefits. And when you think about it, this was right at the time of the CARES Act, where 19 was an okay year, 20 was becoming a terrible year. And so they were able to get their hands on a lot of cash, even though they had set aside money to pay their 19 return. We were able to basically wipe that out, so they didn't have to pay it. So they had more operating cash, and add that to the PPP loans and all that, and they were in great shape.
Yeah,
and it was all it's money that's basically sitting there.
Yeah, so I highly encourage our listeners to really think about this opportunity. As we wrap up here, I've placed my email or my website out there. Please feel free to reach out to me, contact me directly. My contact information is there so we can follow up and put you in touch with Joel. And Michael, any final words from you as we wrap up today? Somehow you went on.
This is just, one small sliver of the benefit we bring in our partnership for clients in identifying opportunities and being proactive and holistic in planning and being fully comprehensive. And, the objective is when the client wins, we all win. And so it's leveraging our relationship. And I was sitting here thinking, gosh, don't give my contact information. Call Michelle. Call Michelle. If you call Michelle, she's calling me. We're going to call Joel or whoever else we need to speak to. But Michelle's our point. We partner with CPAs because it makes the most sense for clients. And, this is the stuff we love to do day in and day out.
Absolutely. And Joel, thank you so much for offering all your insights. Do you have any closing words for our group here?
No, I think enjoy the opportunity. I think just the idea being that in any situation, we're happy to take a look at the depreciation schedule or the project budget and run the numbers. And then you can look at it and see whether it makes sense for that situation. And there's a number of different ways to look at these things, and it doesn't hurt to ask. There's no cost to do that. Yeah,
that's a great point. So just a preliminary look by taking a look at depreciation schedules. Joel can give us a quick idea of what a benefit would look like to you. No cost for that. And I think you'd really be surprised at the benefit because you're pulling in that bonus depreciation. You have the opportunities to carry back. There's just a lot of things that are out there that are favorable to taxpayers right now. So it's really a good time to be looking at this. All right. Well, thank you, Michael. And thank you, Joel, for joining me today. I really appreciate it. Thank you all for listening and watching. Please subscribe to my channel, Health and Taxes on YouTube, and share with your friends if you found value with this, and reach out to me to get your cost seg study rolling. Thank you and have a good day.
Thank you.